Hey folks, in the bloodbath that this stock market has become, my dividend portfolio is now trading down 7 to 8%, sitting around $370,000 after hitting an all-time high of around $390,000, giving me an annual dividend of about $12,700. That juicy passive income, that sleep easy at night income that is helping me survive the volatility of the market and continuing to cost average in on these dips. So we're going to be reviewing my top 10 holdings as they sit today while broad viewing the entire portfolio in the clarity of my transparency. In return, just do the channel a favor, folks. Hit that like button because you cannot run away from a sell-off that is happening in all assets, all equities. You can't touch anything outside of maybe a few exceptions like some oil stocks out there. Take a look at the S&P 500 because even after those stellar mega cap earnings, you thought we would have got a little bit of a rally back, but nope, we're flatlining and selling off today here, folks. The S&P trading down 12% year to date. The Dow is down almost 9% year to date. The S&P TSX, the Canadian composite, after being so resilient this year, is selling off against the US markets. So now it's trading down 1% year to date. The Shanghai markets are bouncing today slightly, giving a little bit of hope here, but still down the most against the Western markets. They're trading down 16% in China. So let's take a look here because you can't even touch security and safety assets like gold, like silver here, folks. Look at silver just getting absolutely plummeted over the last week in this sell-off. So there's no safety in commodities. Even the oil itself, like the oil barrel price, the gasoline prices, they have been flatlining or pulling back. So that's a good sign for inflation. Lumber's pulling back, wheat's pulling back, copper's pulling back. So literally everything that's inflationary based, everything that's tech based, almost everything across the board is starting to pull back. What are people doing with all this money? I don't know. Maybe they're cash sidelining it. Who the heck knows? Because if you thought inflation was going to keep getting worse, which it looks like it's going to get better next month, you think you'd want to be invested in assets, but even real estate is starting to cool off right now. So on that note, drum roll please, as my chakras align to find my best case scenario for my risk tolerance, my comfortability in the current volatility of the market, guys, here we sit with my largest weighting now being the S&P 500 index fund, VOO, making up 10% of my entire portfolio. Many of you know I was sidelining most of my tech for this earnings cycle, and I was debating on how I wanted to go about buying back into tech, and I was thinking about weighting VOO, the QQQ ETF, and I started looking into QQQ because it large weights all my favorite companies: Apple, Microsoft, Amazon, Tesla, Nvidia, Google, Facebook, all that stuff, right? But when I started comparing these indexes together, I've come to realize that I think over the next 5 to 10 years, VOO is actually going to continue to outperform, actually perhaps better than it has in the past. And that's only if you believe that these tech companies still have a really bright future ahead of them. That is my sentiment right now based off those last earnings. And recently, taking a look at VOO's top 10 holdings, they have now upweighted all of these, probably because the market cap capability. I'm not sure how they ended up in this situation, but look at this. The top 10 holdings now make up 30.4%. Typically, the top 10 holdings in VOO were sitting around 25 to 28%, and now they're over 30. So you got to think the top 10 holdings in the QQ ETF make up about 50%. But take a look, because we have Apple, Microsoft, Alphabet, Amazon, Tesla, Nvidia, Berkshire Hathaway, Facebook, United Health Group, and Johnson & Johnson. These companies are absolutely stellar. And I realize that if they're going to continue top weighting these tech companies, I don't need to buy 10 different index funds. I can just buy VOO. It would be one easy stock that I can consistently buy month over month that I think is going to take advantage of my favorite companies. So that's what I ended up doing with the VOO here, folks, leading us into numero dos. So RioCan, this is just because I won't sell it off. I bought it at a great price. I'm now up 6.1% of the entire portfolio on this real estate investment trust, which people have some fear that if real estate does collapse or cool off, that RioCan and a lot of these REITs could get hit, and they could to some extent, but they've already sold off most of their future projects for the next few years. I think they're pivoting really greatly. They have more robust balance sheets than they've ever had after the pandemic. A lot of these upweighted Canadian REITs adjusted their balance sheet, paid off a lot of debt. So I have a lot of faith in them here, and they are trading up 5.89%, outperforming all of the markets this year. So RioCan, phenomenal for me. TELUS, I am a little fearful of TELUS because they have a large exposure to their future growth being in telehealth, and after Teladoc got hit, I am a little fearful for that aspect, but considering their entire business is based off telecom, phones, internet, they have a security side of their business, they're involved in a really diversified way in the Canadian markets, and they've never missed an earnings so far. in any major way. And they're trading up 8.13% year to date. So I'm really bullish with TELUS here. I think they traded a bit of a premium value, but earnings are coming up, at the beginning of next month. So in a couple weeks here, we'll get to see how TELUS is performing, being my third largest weighting. Johnson & Johnson, guys, another one that I just can't sell off. I've held it for too long, and it has grown into the scale of position that we're seeing in the portfolio. It is trading up 5.64%, also posting really great numbers, leading into Pepsi here. So you'll notice that all of my top weightings at this point are largely diversified between not only economies, but really drastically different sectors of the market. So with some of the Canadian market, the US market, everything from real estate to telecom to healthcare to consumer packaged goods. And Pepsi, guys, also doing pretty well this year, relatively remaining flat. This one also posted good earnings because of the pricing power of their products. We all love, Pepsi products, Doritos, chips, all that jazz. So Pepsi, I'm really glad that this has become a top weighting because these have really stabilized my portfolio and income through this crazy volatility of this market, right? So VYM, I've been in and out of VYM, but right now I'm just kind of holding it as a placer for now. I like it because it's extremely stable. It is pretty much, it is starting to trade down 3.58% year to date, but nothing against the similarity of, say, the S&P 500 indexes. So it's a much better place to park capital, collect income, and own all of those really great dividend companies like McDonald's, Home Depot, Procter & Gamble, all that stuff, right? So I do have a little bit of that in here right now, but that's just kind of sitting for a Parker place. We'll see what that looks like moving forward, but for now, I'll probably just leave it. Maybe even continue to add to it if I'm still kind of, just uncertain about where I want to put capital in those dividend companies. But Algonquin Power and Utility Corp comes in just below VYM here, guys. And this one also been very stable this year, trading up 2.92% because everybody's been running to energy and utilities for security this year, along with those consumer staples. And then finally, guys, we've got Tesla. Tesla is the only real kind of upweighted S&P top 10 company I'm holding right now. And it would be a lot bigger of a position if it didn't pull back so much recently. It should be up there closer to Pepsi, I would think. But for right now, guys, I cannot sell my Tesla stock. And the reason I chose Tesla over, say, Apple or Microsoft, even though all of those are incredible good buying opportunities here, in my opinion, Tesla I can't let go of because it is the fastest growing S&P top 10 company right now. If I'm playing a balance sheet game here where people are like, oh, well, Tesla's not worth its value if it's not going to grow at least 40 to 50% currently year over year for the next 5 or 10 years, and they're growing over like 100% on some aspects of their income, right? Which is astounding. Like getting the EPS growth that they're getting, if they can even get that for the next 3 to 5 years, they're so well, it's hard to debate the value of Tesla, but I just figure it is my favorite company right now. It's the fastest growing company, and it's going to be volatile, but I can't get rid of it. I just can't. I've been through too much with Tesla. It has a place in my heart always, so it'll have a place in my portfolio. We'll see whether that works to a detriment or whether it benefits me in the long run. And then finally, Smart Centers being the 9th position, making up 50% of my entire portfolio here, guys, these top 9 positions. And Smart Centers being more correlated to RioCan, very similar real estate investment trust. This one has been relatively flat year to date with a much higher yield, but this is because I also don't own real estate. And because I don't own real estate, I like being heavy weighted REITs because we can see right after Smart Centers comes Stag Industrial, an industrial REIT. And then we finally get into the rest of my positions that are much smaller weighted. So we've got TD, Bank of Nova Scotia, Canadian Imperial Bank, Pfizer, Verizon, which I'm getting hit on pretty heavily right now, Northland Power, Enbridge, JP Morgan, Royal Bank, Southern Company, Procter & Gamble, Canadian Apartment Properties, BCE, Bell, and then we got Bitcoin, and then I have a private placement in here that's very tiny. The private placement, guys, is something I haven't talked about a lot on this channel, but I am in a company that is going to be going public that I currently own off market shares in, which I'm kind of intrigued about. That probably will go public toward the end of this year, and I'll talk about it then. And then just to round all of this off, guys, taking a look at the dividend income pie, this pie right here represents literally how the income is diversified, and this is just making me sleep so comfortably at night, making that $12,700. And again, some of this is fully taxed, some of it's not taxed at all. The whole goal is to be right around $1,000 a month in income after taxes, and it's all coming off drastically different sectors of the market here, with probably the largest of my income, if we just take a look, guys, between the US side of the portfolio here, telecom side of the portfolio, we've kind of got the financials making up a huge piece, but nothing really makes up much more than 20% of a total income from a sector. So the entire economy would have to collapse for me to be losing any kind of dividend income right now, which is making up about 3.4% of the current value of this portfolio. So kind of bringing it all together, guys, you'll see that I'm even cash flowing my cash right now, which I've been upweighting a little bit. The bank savings savings rates have been going through the roof right now. So through the roof by definition of going from like a 0.2 to 0.3% savings rate to what it is now at about a 1.3%, at least here in Canada. So I'm able to, on every 10,000 I put away, I can get $130 pretty much risk free. Bitcoin, I'm still cash flowing, and I would pass that off to you guys as well. If you want to cash flow Bitcoin in Canada, just get the Shakepay app, come in through the referral. You have to come in through the referral to get access to the program where you shake your phone every day in the app, and you really do get exponentially more free Bitcoin every day you don't miss. That's something that I highly recommend every Canadian do right now, because I've actually been making really good money, at least 150 to 200 a year. It's like 50 cents a day once you get up there, so it's beautiful. I love my Shakepay. Outside of that, the only other stocks that aren't yielding me anything right now is Tesla and the private placement. So literally outside of two investments, everything else is cash flowing, and that's where I want to be in this market, just because I do want to start taking advantage of continuing to cost average into the S&P 500 index, while potentially taking on some more riskier investments in the upcoming months once I get through basically my tax season for my corporation, which ends at the end of May. And then I'll have a really good situation of where I currently sit with my cash and where I'll start continuing to cost average into the market depending on how the next month goes. But at this point here, folks, if you want to support the channel, just go to thechartmaster.com. You can get many different automated spreadsheets. Just this one's not automated, but you'll get better spreadsheets than I'm using here, so you can keep track of your portfolio and understand your sector allocation and your dividend income much better. It would support the channel. One-time fee, get like a dozen different charts, mess around with them, just something fun all around. And I want to pass the question off to you guys at this point. I'd love to know what you think about all of this in that comment section below. How are you balancing your portfolio out? Because I'm starting to realize that indexes, when there's no predictability, is just the easiest place to go, because I feel like you're playing a Russian roulette wheel in the near term here with any company. That's tech companies are trading like penny stocks. Penny stocks are trading like God knows. Some of them are going through the moon and dropping massively, and some of them aren't doing anything at all. It's such a weird market to be in. So I'd love to know about any insight you'd have. I'd appreciate it. So stay cool, stay awesome, and as always, I look forward to catching you in the next one.